Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company that seems to have a bit of an issue keeping its financial reports straight. It involves a company whose name suggests green energy, but whose financials have been seeing red, leading to multiple restatements and reviews by their audit committee. Before we get started, if you are interested in getting insights from these corporate documents, please subscribe to the channel. We also have a Discord community linked in the description below. Let's get started. Today we are looking at an 8K CAD filing from Pacific Green Technologies. An 8K form is used to notify investors of important events happening in a company. The A means that it's an amendment or a change to a previous report. In this case, it's about some previously issued financial statements that the company says you shouldn't rely on anymore. That's never a good sign. It usually means mistakes were found and those mistakes were big enough to make the old numbers unreliable, and it is important for investors to know this. Specifically, this filing talks about unaudited financial statements, which are numbers that haven't been checked over by external auditors. The company's audit committee, which is a group that keeps an eye on the financial reporting, determined that some past financial reports shouldn't be trusted anymore because they contained errors. The first red flag is the financial statements for the quarter that ended December of 2023. The company says it didn't properly account for some financial contracts called interest rate swaps and foreign currency forward contracts. Think of these sorts of deals like insurance against interest rate or currency changes. The company had a subsidiary, a smaller part of the company, that entered into these contracts. During that quarter, they sold that subsidiary and the buyer took over the contracts. So even though the company messed up the accounting before, it's important because it affects how the financials looked at first glance, even though the actual business results were not affected and it had no real impact on the company's profits, cash, or net assets. To fix the issue, the company is recognizing an $8.4 million increase in something called derivative expense. Think of this as the cost or loss associated with the mistake in accounting for those financial contracts. They're also recording an offsetting $8.4 million in debt issuance costs to change the already reported net income, cash balance, or net assets. Fast forward to December of 2024. More errors were found in the same quarter report from the year before the one ending in December of 2023. This is starting to look like a trend of not filing financials properly. Here's where it gets a bit more complex. It seems like Pacific Green Technologies had a disagreement with the Securities and Exchange Commission, or SEC, about how they accounted for the sale of a battery energy storage system, or BESS project, known as the Sheaf project. The SEC, which is basically the government's Wall Street watchdog, didn't agree with the company's way of recording the sale as revenue in that quarter. The company originally treated the sale under something called ASC 606, which is a standard for revenue recognition. After consulting with the SEC, Pacific Green decided they needed to change their approach. The company determined that the sale of the Sheaf battery energy storage system should now be accounted for under a different standard, called ASC 81D. This means instead of treating the transaction as regular revenue, they need to account for the change, while getting rid of these subsidiaries from their books or from their reports. This change won't affect the final net income or cash balance of the company either. To make all the numbers line up with how the SEC wants them to do it, Pacific Green is making some major adjustments. There's a $75.7 million decrease in revenue, coupled with a $59.3 million decrease in cost of sales, of course balanced out by an offsetting $16.4 million increase to gain on derecognition of a subsidiary. The previously self-reported errors, including the $6.3 million increase to gain on derecognition of the subsidiary, the previously self-reported errors, including the $6.3 million and on to another, so the final picture stays the same. Because of this policy error, the company realized that the way they were classifying project under development assets for BESS projects wasn't correct, and they are now classifying it long life assets to be recognized as non-current assets. It seems like new errors kept popping up. By June of 2025, the audit committee found even more audited financial statements for the quarter ended December the year before. The company also admitted that the financial statements for June and September of 2023 were not reliable because of material errors. The main issue here is about where to present the gains from selling off or disposing of the Richborough and Sheaf BESS projects. The company determined that these gains should be within the operating income section, not some other income area, and this is supported by ASC 610-12555, which are accounting standards. The only effect this change had was on the presentation of the numbers in the income statement. To fix this, the company is shifting things around. Firstly, they're accounting for an $11.25 million increase in gain on derecognition of BESS project subsidiaries. plus an equal decrease in other income in the Form 10Q for the quarter that ended in June of 2023. Another $550 million increase in gain on derecognition of best project subsidiaries, which is offset by a similar decrease in other income in the Form 10Q for the quarter that ended in September of 22 for the quarter. That ended in September of 2023, another $550 million increase in gain on derecognition of BS project subsidiaries, balanced out by an equal drop in other income in the Form 10Q for the quarter that ended in June of 2023. Another $520.53 were again offset by a $50 million increase in gain on derecognition of BS project subsidiaries. Project subsidiaries, which is offset by a similar decrease in other income in the Form 10Q for the quarter that ended in December of To sum it up a bit, all of the changes that were reported, plus the newly found errors and some other smaller corrections, together had the following impact on the quarterly financial statements. For June of 2023, there will be an $11.25 million increase recorded for the gain on derecognition of best project subsidiaries within operating income. A quarterly quarter that ended in December of 2023 was a $75.7 million decrease in expenses, a $12.1 million increase in other income, and a 0-2023 was a $75.7 million decrease in other income, and a $0.9 million decrease in other income, and a $0 of project subsidiaries within operating income, and a $0.920 decrease in expenses, a $12.1 million increase in income tax expense for September of $20 million decrease in other income, and a 0.23. There will be an $11.25 million decrease in expenses. A 12.23 was a 75 project for the and ended in December of 2023 was a 75. The company promises that the true impact of these multiple restatements will be reported in the 10K, their annual report for the fiscal year ended March of 2024. The company admits that their internal controls had issues, pointing to two main problems. A lack of US GAAP resource in accounting for complex transactions. US GAAP are generally accepted accounting principles, a common set of accounting rules, standards, and procedures issued by the Financial Accounting Standards Board, or FASB. The second issue was the lack of monitoring controls over the review of quarterly and annual financials, meaning they weren't double-checking their work properly. These will also be reported in the 10K. Finally, the company says that they've discussed these matters with Grant Thornton UCal LP, which is their independent accounting firm. Now, what does all of this mean? Well, the sheer number of restatements and errors raises serious questions about Pacific Green Technologies' financial reporting practices. And while the company claims these errors don't affect the bottom line or net income, the constant need to correct and reclassify numbers erodes trust with investors. The disagreement with the SEC over revenue recognition is also concerning. It suggests the company may have been aggressive in how it recognized revenue, and the SEC stepped in and had something to say about it. Additionally, the company's admission of weak internal controls is a big red flag. It means they don't have a solid system in place to ensure their financial reports are accurate and reliable. In conclusion, while Pacific Green Technologies may be operating in an exciting industry like green energy, their financial reporting issues cast a shadow of doubt over the company. Investors should proceed with caution and carefully scrutinize their upcoming financial reports. Alright, that's our breakdown of Pacific Green Technologies' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.